Okay, so good evening, everyone. I'm going to close the door. So it's recording, fixing my hair. Okay, I'm ready. So Zhang is saying me good evening. So it means that you hear me, that you see me. So I think we can go. So we're gonna finish the stylistic case firstly, and then we move to the next chapter. So I'm gonna share with you quickly. So what we did yesterday. So you must see you must see the 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 result of it. Um, just in case you wonder how the year as a whole has been calculated, I um, I gave some idea. Of course, the amount we have, it's the cash at the beginning, okay? Then we add the 4 quarters for all the other information, okay? Collection, disbursements, okay? Here we have the fixed amount of 350, okay? So we do the same formula that for every quarter, except that we do it at the year level, okay? So we take the beginning cash at the beginning of the year. The minimum cash balance is, so it's a fixed amount, 350, right? And so for the rest, we use the same formula, okay? So we don't care about this one. We don't care about this one. It's not very important, I guess. Or maybe we do actually, because sorry, maybe we do, because now we get certainly gonna use it for the balance sheet. So maybe it's important for you to get that straight. I think you have because I use a template to do mine, and I saw that all the amounts were already calculated. So I think maybe I let the formula in your template for this one. So just be careful that you find exactly the same thing. Okay, so you must have 300 here, which is the amount of before the beginning of the year. This one is a calculation. You get the formula here, but it's the same formula than here and here. This one also, it's the same formula. It's a fixed amount here, and for the rest, it's total of the 4 quarters, right? So that's the sum of the 4 quarters everywhere. Okay, which makes sense, huh? With what if you understand the logic of the document for 1 quarter, you can understand as the logic of the column year as a whole. You just have to say to yourself that here you're talking about 1 year instead of 1 quarter. So you take the information beginning of the year plus what we receive in terms of cash minus what we pay in terms of cash during the year, minus also the minimum we want, 350. Then we reach an amount of excess or deficiency. And so here we got the total we borrow during the year. Here we got the total we pay back during the year. And here we get an information that's going to be important, which is actually the cost of financing. Okay, so this one will be actually the first information we use in the next step. Okay, so I ask you to prepare the 2 last documents. So what I'm going to do is that I'm just going to correct it, not giving you extra time, but firstly it's recorded. Secondly, maybe if you have prepared, you already have the answer. Thirdly, I maybe some of you guys have seen, but I asked to Tram to share in Canvas the solution of this case. So you have already the PDF solution of this case on Canvas. Okay, so we save time. And finally, I'm gonna explain what I do so you can follow. Okay, so we are finished with this document. It's important that you get fixed here because we're going to use this information for the balance sheet. Okay, so let's get ready for it. Okay, so for the budgeted income statement, maybe I'm going to do something which is not very nice. I'm going to do this because actually this is the same information that we have, right? And for here, I'm going to do this as well. Same document that we did before. No, it's not very clean. Okay, let's forget it. Let's make it clean. So let's do it again then. So revenues. So you can see where it comes from. Revenues. the cost of goods sold from schedule 7. And so we got the gross margin. So we just already calculated that, but we stopped at the operating income level. So for the non-manufacturing cost, I've got the amount here. So just have to copy and make the sum of them. Okay, so now we can find again the operating income. Maybe it could have been even better to copy this one and just finish the job in here. But okay, so interest expense, now we have it. So the interest expense is here. I'm gonna put it in take it in absolute value, because for once I didn't put my cost with negative sign. So we should have this for the EBT, which is the earning before tax, and we can calculate the tax. And so that's correct here. We will reach that in a few seconds. And sorry, I did a mistake. This one time. And so we have 2 million as here was sharing in the chat, 2,807,443,334. Sorry, I'm still waking up. Okay, so this one was not difficult at all. So that's correct for Chung as well. I don't know if some of you guys finished the balance sheet, and maybe you can share in the chat what you found for the total of assets and the total of for the total of the balance sheet. Okay, let's move. Wow, that's Professor, please point out my lack. I have calculated that all BS items match the PDF solution except accounts payable. Okay, so I'm going to do it, and we see what we have, and I go for the accounts payable. For the accounts payable, my I know what you missed. Firstly, what you have something, you always calculate the difference, right? The difference between between the solution and what you have. And certainly for the accounts payable, my guess is that you forgot the tax payable, because we just calculated some tax here. Okay, so please check the difference comes from this, because now of course it becomes a tax payable that was not existing before. Okay, so maybe it comes from there. And again, if you have any difference, please calculate the difference to see what it is. Okay, so for the cash from the balance sheet, it's of course the ending cash of Q4. So for the accounts payable, actually it's for the accounts receivable, sorry, it's what we have in the beginning balance sheet. Okay, so that's why I put the somewhere at the beginning balance sheet. No, I didn't put it. Okay, so we have to copy. So 1711. I could have put the balance sheet, the beginning balance sheet somewhere. Okay, plus all the revenues that we have in total sales minus what we pay in the cash budget. Okay, so also cash budget, so it must be that amount. Okay, that's correct. Okay, okay, sorry, I put it here. Okay. So here, the way I explain it, so beginning balance sheet, IS is for income statement, and CBIT from cash budget. So it's also a way for me to it's also a way for me to explain to you the that it's one thing which is important for me is the link between the three documents. okay? The balance sheet, income statement, and the cash budget. Okay, so we can see that the ending amount for the accounts receivable, so the amount we still have to receive from the customers at the end of the period, or it's a budgeted, so we should have at the end of the period, 2021. Okay, so it's the amount at the beginning, the amount that the customers owe us at the beginning, plus all the new billing of the year, so all the new sales of the year, minus what the clients pay during the year, right? So this is what we have left. Okay, so it's important because it really shows the document and the articulation between the three documents. So it's also here we are in between management accounting and financial accounting. Okay, so it's also for me a way to check that you are comfortable with the financial statements. Okay, so knowing that I know that some of you guys have more or less experience about the financial statements, again, the pre-readings of this course of the previous course, but for this course as well, you're gonna discuss again that kind of topic with other professors. Don't worry, you're gonna have other chances to get more comfortable with this if you're not. I'm thinking about the financial analysis class with Professor Chevalier. I also think about cash management elective with Professor Eric Maton, who's gonna work again on these aspects about the cash budget, but gonna go into other directions. So hopefully it's gonna complement what we have seen together. So for the direct material inventory, of course, we try to find what is the ending inventory. Okay, so for the direct material, we got two raw materials that we have already identified. So sorry, I'm gonna take the same classification than in the official solution. I'm less and less convinced by the total and details column. Okay, so let's not worry too much about it. And so for the total current assets, we have the three ones. Okay, so again here we have the information that we can find in the ending inventory. Okay. And for the first one, I'm just copying explanations from the official Excel solution, so you can benefit from these explanations. And so we got the total of the current assets here. Okay. Property, plant, and equipment. So what do we have? So we have land, okay, which is 2 million. And we got building and equipment, so it's 20 million at the beginning. Okay, do I have my zero? Yeah, I think so. Plus new fixture that we bought. Okay, and for the accumulated depreciation, we have the beginning inventory, beginning accumulated depreciation. Plus we have to find the depreciation. Not easy to find this one, I guess, because it's in the manufacturing cost that we need to find it. So we got some depreciation here and some depreciation here. So okay, so it's not the same amount. So let me do it again. So we have 6,900,000 plus 1,020,000 plus 603. So that's correct. So I must have taken a wrong cell in my calculation. Okay. So the accumulated depreciation okay. So sorry, for the fixed assets, which are tangible assets, we get a net amount of 14 million. And so we can now calculate, I don't know what I did in my official solution. Okay, no big deal. So total PPE. So it's the sum of these things. And for total assets, we have the total of current assets and fixed assets. Okay, so we should have this for the total assets. Okay. So I can add the elements that I have in my official solution to share with you. Okay, so you have more explanations here. All right, so this is it for the asset side. So for the liability side, so accounts payable. So we reach the question of Mr. Kian. So we're gonna check if we can find a solution. So the beginning amount that we find in the original balance sheet is 904,000, okay, plus the new purchases, okay, here in the material and labor cost budget, 9950, okay, and minus everything we paid in the cash budget, so which is here, direct material, I guess. Yes, this is the amount. So sorry, so what you did 904 plus, I don't know what you did, the 3 million. Okay, it's because, okay, so it's not what I said earlier, because the account, sorry, the account tax payable, it's a separate line, huh? So maybe you check that in between. So I don't know where you find your 3,683,110. I don't know where you find that. And for the minus 3,599, I don't know either. So I don't know what to say to you, Kian. Maybe you can just check what I did. Okay, so beginning balance sheet for the accounts payable, and then the only accounts payable for which it's not paid directly is the raw materials purchases. Okay, so we got here plus, and in the cash budget we got minus here. Yeah, for the direct material. So for the rest, I think it's okay. We pay directly the amount. Okay, ignore it. We'll check it later. Okay, so yeah, okay, no problem. Sorry about that. If you have a question, you can mail me, right? So income taxes payable, as I said, we have a new amount here. So sometimes this one people forget. It's, you know, it's interesting because we just created this expense, right? And it's not paid yet. So yes, it should be a debt in our current liabilities, but you know, it's not so easy to think about everything. But since it's said it becomes tax payable, at least it's a separate line. So I think people can not forget it. Maybe it would be trickier if it was everything in the same payable account. For stockholders' equity, so for stockholders' equity, no, okay, no, I'm totally wrong actually. Okay, sorry. So for the accounts pay, for the income tax payable, it's the same thing than for the payable, sorry. So we have a beginning amount, 325 in the balance sheet, okay, because this is an amount that was due to the government, okay, plus, of course, what I just said, plus the new amount, minus what we paid for the income tax must be here, right? Sorry, no, it was actually the same logic than for the rest. Okay, so total current liabilities, it's here, okay. Stockholders' equity. So I think there is no change in the stockholders' equity. So we have 3.5 million. So that's beginning balance sheet normally. Sorry, it's here. Common stock. And so for the retained earnings, well, we have the beginning amount, which is 16,108,000 plus the new profits that we have, 2,807,000. Okay. And we could have here among the disbursements, we could have some dividends that could be paid. So we have nothing. So it's finished for the formula. And it's not the good amount. So no, because, okay, something happened with my formula. So again, we have a beginning amount plus the net income. So that's correct now. Okay. So total stockholders' equity. This is 22,425,334. And so now we have to check that our balance sheet is balanced. So we have the same amount, both sides of the balance sheet. So this is correct. We get the same amount here and there. So it's usually a good sign. It's usually a good sign that we did not forget anything. So it's very hard to balance a balance sheet like this. I don't know if you took some time to try by yourself since yesterday. I know you're busy, so with your job, so maybe it's not so easy for you to find the time to do it. So it's usually, of course, something which is difficult. So I would say that normally, I mean, it's normal if you have a difference, right? If your balance sheet is not balanced, it's quite normal because it's quite difficult, right? Not to forget anything. If you have any difference, do not forget to calculate the difference between the two sides of the balance sheet, okay? Always do this. You can call it a check or something like this. This is my first advice, okay? Because the amount can ring a bell to you, say, oh yeah, I remember this amount. And so, you know, it can help you to, you know, to find where is the missing information. But of course, it's not always so simple because maybe you forgot several things. So the difference will not ring a bell. Okay. So you have also to be quite, you know, quite concentrated when you do this. Okay. Even if what you did before is wrong at some places, you can have a balanced document here. As long as you know what your mistake is on both sides of the balance sheet can work. So it doesn't mean that because you have a balanced document, it's okay, because maybe you forgot totally one information on both sides. Okay, because you know that accounting is about debit and credit, right? So there is always one debit and one credit for each information. So if you forget the information, debit and credit, of course, you forget it all over the place. Okay, so, but usually it's already a very good sign if your balance sheet document is balanced, because it means that all the information that you took into account has been well treated, right? Because it's balanced. So even if you forgot something, okay, you forgot it totally, okay, all the rest that you treated at least is a good thing. It's a good thing, okay? So you'll see that the individual assignment, the first part of the individual assignment is a job like this one, okay? So you can use the same strategy that the one we did for this one, okay? And so I will be able to check if you have well understood how it works. So we're finished with the stylistic case. So I don't know if you have any question in the chat. So sorry, Kian, I was not able to check the detail of your calculation. So I have a question. So accounts payable only calculate for material. Yes, yes. I don't know. I don't remember if it's in the case it said like this. but it's supposed that the rest is paid cash, right? There's no delay for payment for the rest. Maybe it was not clearly said in the case, so that's why your question makes sense, because it means that I'm not sure it was said, but maybe we can check. Usually for the individual assignment, it's going to be the same for you to, if you, I mean, just to know. Okay, I have a, okay, so my wrong is I calculate all expense. Yes, but you know what? I remember the first time I was doing this case, you know, I was also doing this because I was saying that yes, we can have some delay of payment for different type of expenses, right? So it's just that maybe we can try to find somewhere in the case where it said that that all the expenses are paid cash, but I don't remember this. I'm just checking, huh? So no, I think it's not said nowhere. So that's why your question makes sense, because it should be said somewhere that only maybe, okay, yeah, no, for the accounts payable. Okay, so I don't know if we can also check quickly before we move to something else, because I would say that to some extent it doesn't it should not be a problem. Okay, I'm going to put it here. I'm going to take a formula. If we do, okay, we have no, okay, so we have no beginning balance sheet amount for, let's say, other things, like, for example, what would it be? Let's say for direct labor, for example, I'm going to try this. So we get 6 million here. And so, sorry, it should be, so we have 11 million here. Yes, because we have non-manufacturing cost maybe with, sorry, not manufacturing cost, but manufacturing overheads, for which we have certainly some cost here also. So no, it was not so easy to check, that's true. So yes, maybe it should be said somewhere that the only delay of payment is for the purchases of raw materials. So yes. And I think for the individual assignment, it's the same. Okay, so you can use the same technique for, yeah. So it should be said somewhere. That's true. It's missing information. Sorry for that. Just checking something. Checking something quickly. Okay, no. So I was trying to check something, but I don't have an additional explanation to give. Okay, so I have no question in the chat, so I think we can move on. Okay, so we are finished with the with this case. So you have the solution already online. Okay, I gave that yesterday because I thought, like from Mr. Kian, that some people would like to to have the solution so they can check already. So we can move to the next step, right? Okay, so let's move to part 2, which is about the flexible budget, cost variances, and cost variances and management control. So here, what we're going to discuss is actually how to make the calculation of the variance. Okay, so the variance, which is something important in this chapter, is the difference between the actual results and expected performance. Okay, so that's the difference between the budget and what really happened. Okay. So of course we must wait for the end of the period to be able to do that, to know the actual performance, right? And the idea is that, of course, the job of the management accounting department is to investigate the variances, right? Firstly, to understand what caused the variance, okay? And as a consequence, what we can do, right, to improve the situation. So what can we do to correct the variance? So again, we make a budget before the beginning of the year. And then at the end of the year, we know you just compare the reality with the budget to see if, you did well, right, during the period. So we cannot investigate all the variances. So usually people from the management, they will try to focus more on big variances, okay? And maybe it's not very important to investigate areas where the variances are not very big. Okay, so the process is like this, right? You prepare the budget, so it's just to be sure that we all agree on the timing. So prepare budget, we prepare the budget, like for example now, okay, so we are December 2020, so we finish the budget for 2021, okay? Then 2021 happens, okay? And so we collect the actual performance, and at the end of 2021, we compare the actual performance and the budget, and we do what we say, we exercise control, meaning that we try to interpret, to understand, and maybe go and see people who are responsible for a good or a bad performance to say to them how we can improve the situation, okay? So we're going to use these variances to identify areas in the company where things are not very efficient, okay? So this is what we do. I said we wait for the end of 2021, but usually when it comes to variances, it's a monthly basis, okay? So we prepare the budget for 2021, okay? So then January 2021, we perform. At the end of January 2021, we compare actual performance with what was planned in the budgets for January 2021, and then maybe we can, calculate the variance, try to understand why, and maybe try to correct, okay? So usually variances are calculated on a monthly basis. Here, this chart is also complementary to the previous one. So we prepare the budget, we perform, we collect information on the actual performance, then we give some feedback, okay, to the management, and the management give some feedback both to the areas who are performing, so to the operating managers, okay, you should improve this process, or you should do this or do that. But also, it's important also, we give some feedback to the people who prepare the budgets, okay? Because, and that's something I'm gonna repeat several times, when you have a bad performance, meaning a negative variance, an unfavorable variance between the budget and what really happened, we can tell that maybe this is also because the budgeting team has been too optimistic or too pessimistic. Okay, so this is something I said, I think, at the beginning of the seminar. Be careful also to be critical with the budgets themselves, okay? Before taking accountability to someone, like the person who is responsible for the production, you go and see this person saying, you got an unfavorable variance, you spent more money than what you were expected to do, it's not good, we are not happy about your work and everything. Maybe, before doing that, just check that the budgets themselves were properly done, no mistake, and maybe they took into account like an information which is not good about, I don't know, the number of hours you need to manufacture a product, about the number of employees and so on. So also when you have a variance at the end of the period, let's provide some feedback to the budgeting team. Let's be, if we are this budgeting team, let's be critical to ourselves as well. Should we change? And maybe we need to adapt the budget for the next period, right? So is the budget correctly done? Is it too optimistic, too pessimistic? Shall we change it for February or so on? Okay. The budget have to be, you know, reachable and fairly constructed. Okay, so let's not forget this. Usually, what we're gonna learn to do this morning is how we organize our calculations. So usually we're gonna have on one side the budgeted profit, on the other side the actual profit, and so we're gonna have in between calculating the variances for each of the categories: direct material, direct labor, and so on. And so it will make appear some favorable variance, some adverse variance, okay? And so we will be able also to understand better if the bad performance of the month is more due to raw material problems, to labor problems, to other problems, okay? So we're gonna get into the details. So this is what we're gonna learn to do. We're gonna learn to get to you know, structure, to calculate sub variances about firstly raw material, and then we will move raw material between price and quantity, and so on and so on. So we can understand better, we can analyze better the situation. So this is what we're going to learn to do now in the next slides. So the first budget you need to learn about is what we call the static budget. Okay. Globally, the static budget is like the budget we did in the stick case when we do the budgeted income statement. Okay, so the static budget is actually the income statement budget that we prepare before the beginning of the period or at the start of the period. Okay, so again, so we are in December 2020, we just finished the budgeted income statement for January. So this is our static budget, okay? And then we're gonna calculate the first variance, which is called the static budget variance. This static budget variance will be the difference between the actual result and the budgeted amount in the static budget, okay? Of course, if we have what we call a favorable variance, so it's a question of vocabulary here. If we have a favorable variance, it's when actual revenues exceed budgeted amounts when actual costs are less than budgeted costs, okay? So we have a positive, and unfavorable variance is the opposite way, okay? So just let's say that, of course, it makes sense afterwards, the rest of the sentence, but let's just agree that we're going to try to qualify the variances as favorable or unfavorable. Okay, so also sometimes we have to be careful about the sign of a variance, because if you did that already in the past, or if you look at one book or another book, or if you have another professor in the future, and so on and so on, sometimes the calculation will be done in one way, sometimes it will be done in the opposite way. Okay, we're going to do budget minus actual, or sometimes you're going to do actual minus budget. So be careful about this, but you're preparing a master in economics and finance, right? So I think you should be quite comfortable with calculations. So my advice here is, don't trust the sign of a variance. Okay, it's not because a variance is negative that it's not good. It depends on which side has been calculated. So always take the time to step back a little bit and say to yourself, okay, is it good, or is it favorable or unfavorable? Is it like, okay, the actual cost is higher than the budgeted cost, so it's unfavorable because I spent more money than what I expected. Okay, so always take the time to do that, and do not say negative or positive variance, but maybe more favorable or unfavorable variance. Even if you'll see that in the Excel file I provided you, I try to build them in a way that you usually, when it's negative, it's something which is unfavorable. But still, okay, please be critical. Take always the time to step back and imagine is it good or bad for me, this variance. So we're gonna now get into the details of the calculations of the variances, and we're going to use one case, which is also provided to you, which is called the web company. So you must have it somewhere in the canvas. And so it looks like this, okay? So you consider the web company. So it's an example from the book, so you can also check in the book if you want afterwards. But I think you don't need it. I mean, we do everything together. Okay, so we get a web company. So it's a firm that manufactures and sells jackets. Okay, so usually when it comes to variances, usually we're gonna use some manufacturing company because it's easier to imagine the variances. So we have raw materials and stuff. So it's easy to understand the process. So the jackets require tailoring and many other hand operations. So web sells exclusively to distributor, who in turn sell to independent clothing store and retail chains. For simplicity, we assume that web's only costs are in the manufacturing function. Okay, so that's quite usual when it comes to variance and management accounting. Usually we're going to focus on the manufacturing process, okay? It means that we're going to exclude the selling, distribution, and stuff like that, okay? Maybe later you will study this. Of course, you can calculate variance about those aspects as well. But I think for a first step, for a first approach of the variances, it's more important to focus on manufacturing costs. Okay, so we're going to focus on manufacturing cost and revenues. So web incurs no cost in other value chain functions such as marketing and distribution. Okay, so that's theoretical. We assume that there is no cost in marketing and distribution. Usually there are, but it's another story. It's another job to analyze. So we focus on the production, on the manufacturing aspect. We also assume that all units manufactured in April will be sold in April. Okay, so here we simplify a little bit our job by excluding the inventories issues from the calculation. Same thing, of course, you can have some, but we have 15 hours to talk about this, so I give you the fundamentals. Therefore, all direct materials are purchased and used in the same budget period, and there is no direct material inventory at the beginning or the end of the period. No work in process either. And so now let's get into the details. Okay, so we get 3 variable cost categories. Okay, so we get 3 variable costs. Okay, so here these costs are variable. So certainly we will talk about fixed costs later on. Okay, so in the variable cost we get direct material, direct labor, and some manufacturing overheads, which is variable as well. Okay, so it seems that to manufacture a jacket we need to spend $60 of direct material. We need to spend $16 in terms of direct labor and some other variable manufacturing costs for 12. Okay, so this is the information we have. Okay, number of units manufactured is the cost driver for direct material, direct manufacturing labor, and variable manufacturing overhead. Okay, the relevant range for the cost driver is from 0 to 12,000 jackets. Okay, so it means that if we are out of this range, maybe we should rethink about the value of this cost, and especially maybe the fixed cost. What do we have? So we have additional information. So is it for 1 month in particular? Yeah, for April. Okay, so we are working for April. So we got the budgeted fixed cost for April, budgeted selling price $120 for April. So it seems that we have a selling price of $120. We have 88 for the variable cost. So if you make the difference, we should have, if I'm not mistaken, $32 for the contribution margin per unit. And then we need to sell enough products to cover the fixed cost. Okay, and so we have a budgeted production and sales in jacket, 12,000. And we have here finally information that we reach at the end of April, which is actual, okay, actual production. So in the budget, we prepared the budget for 12,000 units, and finally we sold 10,000. Okay, so we're gonna see 3 levels. Okay, so level 1, level 2, level 3. So level 1 analysis, first step. So each level we're gonna get more and more deeper and deeper. Okay, so now it's time for you to do level 1, so which is to present the static budget and the static budget variances using the templates provided. Okay, So if you have a look at what is provided, so I didn't open the file yet. So you have the template in your canvas normally, which is called web company template. Okay. And so I'm going to share that with you. And so what we do in this part of the seminar is that we go back and forth from the Excel file to the theory. Okay. So you find here the information about your web case, the web company. So here the information, the data is the information that is provided in the case. You will certainly remember it. We just discussed these amounts, 88 for the variable cost per unit, budget fixed cost, and so on. Okay. And here you have a structure of the income statement that stops at the operating level, because we said that I'm going to save it as a WIP, work in progress. Okay, so it stopped at the operating working level because we said that we don't go further, right? Okay, so you have the information about the actual results. So we sold 10,000 units. The revenues have been 1,250. Direct materials, you have the information. So usually try to do like me. If you want not to have issues with the signs and everything, when it costs, you put a minus sign, and when it's revenues, you just make it positive. Okay. So we got the contribution margin, which is revenues minus total variable cost, okay, minus fixed cost equals the operating income. So first job for you is to reconstruct this column, static budget, using this information, okay? And then you can calculate the variances between the two things, doing actual minus static, okay? And here it's to qualify, is it favorable or unfavorable? So you just put a letter here, okay? So do you have any question about what you have to do? If not, okay, so I'll let you 5 to 10 minutes. Can you explain again about variable cost per unit? Okay, so the variable cost per unit is the sum of the three variable costs here, okay? So the variable cost per unit of 88 is the sum of the direct material per unit, direct labor per unit, and manufacturing overheads per unit. And so we have two types of costs, right? We have variable costs and fixed costs. So usually variable costs are costs which are calculated per unit, because the variable cost, per definition, which is a cost which is proportional to the level of activity. Okay, and okay, this way. And so fixed cost is a lump sum. Okay, and so the contribution margin is sales minus variable cost. Okay, and so this contribution margin can be calculated or total or per unit. Okay, so I'll let you 5 minutes, and then I come back to discuss with you the results. Sorry, I was gone for 1 minute. So we got some answers. Operating income 44. Let me check for the, I'm gonna open the official solution at the same time. So operating income 44, no, that's not correct. Yes, the variance is minus 93,100 and the static budget is 108, so that's correct, yeah. So Trung is correct, Hong also, Zong also, Trung is correct as well. Yeah, okay, so it's unfavorable and that's it. Okay, so yes, we can go for it. So I'm gonna share my screen. I'm gonna solve that with you. Okay, so for the static budget already, what is the quantity? It's was based on 12,000. So for the revenues, we got 12,000 times the selling price. Okay. For the direct labor, we have, for direct materials, so we get 60 times 12,000. For the direct labor, we have minus 16 times 12,000. Okay, so we can see that everything is based on 12,000. So I can see that I have a lot of answers. So I think a lot of you guys are comfortable with it. I'm just trying to find the right pace to inform everyone, maybe the ones who have less experience about costs. So variable cost per manufacturing overhead per unit, same thing. So we can see that everything is based on the number of units which is in the first cell, right? Okay, then we have, so the total variable cost is the sum of the three ones. The contribution margin per unit is sales minus variable cost, which is already in a minus sign, so I just plus them. The fixed cost is for provided, okay, and so of course we have 108, as some of you guys found in the static budget, okay, and so if we do then the differences between actual and static, this is what we find. Normally we can just do this way. That's why it's important for you to put the minus sign for the cost, so it appears already with the good sign in the variance column, even if, again, be careful with signs. And here, this. Okay, so that should be correct. I'm just checking with the official solution. Yes, it's correct. Okay, so now I'm going to qualify my variances. Okay, so this one is unfavorable because we plan to sell 12 and we sold only 10. Okay, so for the revenues, we have an unfavorable variance as well. For the direct material, we have a favorable variance, right? Because we have less cost than expected. No, it's unfavorable for the direct labor. It's favorable for this one, favorable for the variable cost, unfavorable for the contribution margin and the fixed cost as well, and so the revenue. Okay, so we expected to have 108, we have only 14,900. Okay, so that's big difference. So in the chat, I would like to to ask you one question. So firstly, is that okay? I mean, there are a lot of you who found this, so I think it's okay. If it's okay, can you tell me what do you think about this? Is this something how can we interpret this 93,000 here What does it mean? Is it something we could interpret, or is it something we should not interpret? Is there something we should be careful about? Is there, you know, okay, we can say 93,100 less than expected, but still we should certainly be careful of something. So what do you think we should be careful of? Why is not something we can use directly, this static budget variance? Why is it not so clean to interpret? What do we compare? Is it fair to compare the two things? If not, why? Why is it not so fair to compare the static budget and the actual results? Let's take another lead. If in reality you sell 0 products, okay? So you have a static budget with 12,000, and finally you sell 0, okay? The direct material cost will be 0 in reality, right? So you will have a favorable variance because you plan to have 20,000 and you have 0. Because static set up from beginning with fixed cost. Yes, it's not what I expected for the answer. Something else? Yes, there is a difference in the fixed cost, of course, in between the reality and what was planned. We will see why, because normally people say, why do we have a difference in the fixed cost? Well, because when we did the budget, maybe we did not plan that a machine would break, and so we have to replace one machine, so we have an extra depreciation. So yes, it can happen that in the reality, the fixed costs are higher than in the static budget, but it's not the variance that is easy to interpret, or there's not much we can do about it, because it's a lagging indicator. What do you mean by lagging? Like it's from the previous period? Is this what you mean? Because the static budget is made in the past? No, prof. So what do you mean by lagging indicator? Because for me, lag, when we do some research in finance, when we say lag is usually the information from the previous period. So that's why it is impacted by different indicators. Yes, sort of, and maybe we can complement with what Hang is saying. What is really the difference is that we do not compare. It is impacted by different indicators such as fixed cost, unit, sales price. No, that I think it's not a problem because this is what we're going to do today. We're going to try to split the cost into quantity and prices. We're going to separate variable and fixed. Of course, we're going to not interpret the thing the same way. But I think for both of them, for actual and for static, we have variable cost, we have revenues, we have fixed costs. So I think the structure of what we compare is quite similar, okay? We still have variable cost in both cases, which are based on a quantity times a cost per unit. Revenue, same thing, so selling price time a quantity we sell, and fixed cost is fixed cost. So I think on the contrary, I would say that it's the information we are comparing. I don't know what you call an indicator, but the information we are comparing, the cost and revenues we are comparing are quite the same. The only difference is that on one hand, we have some actual information, so an information that really happened. And on the other hand, we have a budgeted information, so something we planned. So that's why I was asking if it was a question of timing, because yes, there is a timing issue, of course, because the budget is made before, actual is made after. So that's why we can have some difference. But we could still compare them, except if, as Hang was saying, is it fair to compare the two things if the quantity is different? No. Okay, so why we should not compare the two directly? It's because we compare information which is built on 10,000 units, and the other one is based on 12,000 units. Okay, so of course, as I was saying, it makes sense that, for example, the direct material is bigger in the static budget than in the actual result, because it's not made for the same quantity. Okay, so this is why I was saying maybe if we consider that finally in actual data we sell 0 products, we have 0 for the cost of raw materials, so it's lower than what it was in the budget, so it's favorable. But it's not favorable for the company if you don't sell 1 product, right? It's not a good thing. Okay, so it's not fair to compare. It's not fair to compare the two. Okay, so what my is trying to do is actually what we would like to be able to do. Okay, to compare the revenues, the costs, and everything. So that will be our next step, how we can do what we really would like to do, to say, okay, we have more or less revenues and costs and so on, because this is what we really do. So it's not wrong. It's just that we don't have the right information to compare here. Okay, so first lesson of the day, it's dangerous to compare actual result and static budget, because they are not based on the same quantity, not based on the same can I call it output? No, same number of units, let's say. Okay. Okay, so that's the first lesson of the day. Let's say that's the first thing which is important to remember today. Okay. So let me come back a little bit to my slides. Here. Okay, so we have in the slides also the results. We can see that. So we have we all find that 93,100 unfavorable. It's a static budget variance. Okay, so I would say here, for me, the only variance which is important is this one, the 93, because this one, the variance, individual variance, as I said, we don't compare the same number of units, so maybe we should be careful about this. The only thing we can say is that we have a static budget variance of 93,100. What does it mean? So normally we have some definition after. So firstly, as we say, it must be interpreted carefully, okay, because it's made for 2 different levels of outputs. Okay, so to fairly compare budgeted and actual information, we need to construct a budget as if we know from the beginning the real level of output. So we need to construct, to change the static budget into another budget that will be built on 10,000 units. Okay. But just to finish with this, so we can still talk about static budget variance. What is a static budget variance? Is actually what does mean the 93,100? Well, it means that when we build a budget, we expected to have 108,000 units, $108,000, okay, of profit. This is what we expected to have in December when we prepared the budget. And finally, we have 14,900, sorry, only. Okay, so we miss 93,100. This 93,100 is actually the total information between what we expected from the beginning and what we have finally, okay? But we need to split that into 2 things using what we call the flexible budget. Okay, so this is the second important information for you today, is to understand what the flexible budget is. So to compare fairly budgeted and actual information, we need to construct a budget as if we knew from the beginning that the real level of output is 10,000 and not 12. Okay, so this is what we achieve with what we call the flexible budget. So the flexible budget calculates budgeting information, revenues and costs, but with the actual output. Okay, so it's like we do the budget, but with 10,000 units instead of 12,000 units. Okay, so firstly, this flexible budget, we have to understand that we can do it only at the end of the period because we need to know what is the actual output before developing it. Okay, so usually companies develop their flexible budget in 3 steps. Firstly, they identify the actual quantity. Okay, so you need to wait for the end of the period. Then you calculate the flexible budget for revenues based on budgeted selling price and the actual quantity. And you do the same thing for the cost. Okay, so this is what we do now. We're gonna do this in our Excel file, right? We're gonna create in the middle one new column that's gonna go into actual results and static budget. It's like we create an intermediary step, okay? So this flexible budget is we do the budget again, but for 10,000 units instead of 12,000 units. So if we go back on our Excel file, and so I'm gonna give you some time to do it. Okay, so you have this information here. So you need to build a flexible budget. So if you understood well, this flexible budget will be based on the actual output. If the actual units is 10,000, we have 44,000 income. Say yes, that is correct. Okay, so I'll let you fill in this document. Okay, I'll let you 5 to 10 minutes to do so. We check the results and we have the break afterwards. So that's true that you should find 44,000 here. Yeah, that's correct, Zhang. Do not forget to calculate the variances here and here, okay? So, so we can... Since some of you guys have already the result, I'm just giving you 2-3 minutes, then I share the solution. Flexible budget variance 29,100. I think it rings a bell, and 64. And you should check that the sum of those two should be the same amount that we have before, 93,100, right? Okay, so I think it's time to, okay, Kian Chung, you have it. Okay, that's correct, Kian and Chung and Zhang. Maybe 2 more minutes for some people to be able to finish. Okay, so let's go for it. Okay, so you should see my Excel file. So again, what is very important is to understand that we're gonna use 10,000 units, but based on, so 10,000 units for budgeted information. Same for Luang, so it should be okay for budgeted information, okay? So for the revenues, we should have 10,000 times the selling price, the budgeted selling price, okay. For the direct material, we should have $60 per unit times 10,000. So it means that for 10,000 units produced, we should have a cost for material of 600. We have 621. Okay, so it seems that it's a little bit more. For the direct labor, we should have 160. Sorry, I'm going to put the minus sign. Okay. Variable manufacturing overhead, 12 times 10,000. So that should be 120. Okay, so for the total variable cost, we have 880. Contribution margin is revenues minus total cost, variable cost. So it's 320. And for the fixed cost, so sometimes people do the mistake here to take the actual fixed cost. Fixed cost is the same than in the budget, right? Because we recalculate the budget with 10,000 units. Okay, so we should have 276 in that case as well. So your colleagues who shared the answer find 44, which is correct. And now we just have to, you know, do the difference. So I try to save some time here. So that's favorable. That's unfavorable. That's unfavorable. That's unfavorable. That's unfavorable. That's unfavorable. Unfavorable and unfavorable. Okay, and for the sales volume variance, we have this minus this. I can drag if I don't care about losing my lines. And so this is unfavorable, unfavorable. That's favorable, 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 but we don't care very much. Unfavorable and unfavorable, okay? in here we have, sorry, we have 0, donc there's no difference. And as your colleague was saying, the total variance, we can reconstruct it, 64 plus 29. We find again the 93, okay? So now we can fairly compare things because we can compare, as Mai was beginning to do earlier, the flexible budget information and the actual results. So these two columns, it's going to be interesting to compare them, okay? And finally, the variances, which are very important for us to analyze, are the flexible variances, flexible budget variances. This orange column is really, really important for us to analyze. This one, sales volume variance, we're going to just say a few words about it after the break. But we compare flexible budget with static budget. So sales volume variance compare to budgeted information. So we don't care very much. Okay? To budgeted informations. So we don't care that much. So we care about this one. So what we did now with the flexible budget, I come back to my PDF document. Okay, we created a budget for the actual volume of activity. Okay, so this is what we call the standard cost allowed for good output achieved. So the flexible budget that we have here, okay, is, sorry, this one. Okay, I cannot grab it. Okay, this one. This information is what we should have been able to do if we have a number of units of 10,000. Okay, for 10,000 units, this is what we should have, 44. And finally, we have less. Okay, now we can begin to analyze why and to understand why. Okay for everyone? So it's 8:25. So let's meet again at 8:45. I will define again flexible budget, and then we will go into the analysis of the variances. Okay, so enjoy your break and see you in 20 minutes. Okay. Okay, so it's 8:45, so we come back to the case, to what we do. And so what do I share? Maybe the Excel file. Okay, let's go for the Excel file. Yeah, I was sorry, I was not I'm not on the good page. I was checking something earlier. Okay, so what I was saying is that now we're going to focus on this one, okay, the flexible budget variances. Before that, maybe just finish with saying a quick word about what we call the sales volume variance. So the sales volume variance, as we can say, is actually a difference between two budgeted informations, okay? So finally, what is white here, meaning the detail of it, okay, we can calculate it, but we don't care because finally is just comparing budget with budget. So it's not those ones we're gonna focus on. We're gonna focus on the orange ones, the flexible budget variances. We can just say one word about this, the global amount, 64,000. Well, what does mean this amount? Well, this is the budgeted profit we will not be able to do because we produced and sold less than we expected, okay? If we respected the budget we did in December with 12,000, the budgeted income was 108. Okay, now we know it's 10,000 only, so our budgeted income is now 44. So the 64 represents the loss in income due to the fact, the budgeted loss in income due to the fact that we are not able to do 12,000 but 10,000, okay? It's nothing else than we can say. It's just budgeted information, so we don't care so much. Let me check on the if I have another way to put it in the so we find it here, right? Sales volume variance. No, I don't say so much about it. Okay, so it's against what I said. Okay, so what is important is that we understand that we do the flexible budget, meaning that we recalculate the budget for the actual volume, okay? For the actual volume, okay? And so now we can fairly compare the information in the flexible budget and the actuals because they are both based on the same volume, which is 12,000, which is 10,000 units, sorry, okay? So the sales volume variance, 64,000, okay, 64,000 is actually, again, the difference between two budgeted information, flexible budget and static budget. Okay, so the only thing we can say is that, okay, we have to readjust the budget by negative 64 because of the adjustment is a level of production, 10,000 instead of 12,000. Okay, so initially we thought we would be able to target for 108,000 profit, but now that we have 10,000, we can only target for 44,000. Okay, and so now we're going to see if this is what happened in the reality. Okay, and so now we can focus on the flexible budget variances. So the ones are in orange in our Excel file. Okay, so let's go back to the Excel file. Okay, so now we're going to get into the details of these ones. Okay, all which is orange. Okay, and specifically, let's say that we're going to focus on what I let in orange. Okay, here these ones, and even maybe these are the ones we're going to focus on. Okay, so this one will be the the selling price variance. Okay, this is the first one we need to interpret. Okay, this first one, 50,000. So maybe in the chat, could you say to me what could be the reason why we have a favorable variance of 50,000 between the actual revenues and the flexible budget? What does it mean? What can be? This is now time to interpret, okay, to comment the results. So if you had something to say to your manager about this 50,000 positive, favorable, what would you say? What can be the reasons why we have a favorable variance on revenues? So I expect some answers in the chat. Actual selling price is higher. Yeah. So exactly. So the reason why is that the selling price is higher than in the budget, not lower, higher, right? We could even say, we can even calculate it because it's we got 50,000 and this is for 10,000 units, right? So we have a positive 5. So the selling price has been, 125 on the average instead of 120. Okay, so then we can think about the reasons why. Okay, so the explanations why could be, okay, maybe the budget was too pessimistic. Always we can say that. Okay, why could be other reasons why pessimistic? Why could be other reason why we have a selling price of 125 instead of 120? What could be the, on the field, what happened? What could be the, discount sell? So that's a good one. The discount have been lower than predicted. Okay, so maybe that when you say 120, you take into account the fact that the salesmen on the field, that on the average, okay, they negotiate and they give a discount of 10% or something like this, or 5%. And this time they have been better than what is expected, so that's good. We had, for example, this problem we had this problem in sorry, I was thinking about something else. In Disney, I've been talking to you about Disneyland Paris, that we've been training the managers. And so if you remember what I said, we had some people from the marketing departments for the, let's say, more from the online selling, online ticket selling. Okay, and these people were very challenged on the discounting, because Disney was known to give a lot of discounts on the price, because maybe the price which is announced is the price, and then from there is a part for the negotiation. And so sometimes when you have like large groups from Middle East or Russia who comes and negotiate, or if you have, for example, one company, it can happen that one company for Christmas, for example, you have a large company like, I don't know, Vietnam Airlines, for example, they would like to offer, maybe not this year because of the COVID, but or they would like to offer a present to all the employees, and so it's going to be a ticket for Disneyland, and so they're going to negotiate a price for I don't know, 3,000 people. Okay, and so of course they're going to have some power to negotiate a discount. Okay, so maybe we anticipate that in the price when we say 120 here in the budgeted price, maybe that takes into account some discount that we usually do, 10%, 5%. Okay, and so finally, the fact that we have 125 instead of 120, that could be a first reason why we have a better price. Okay, or we can have yes, so that could be a good reason. You see something else? I was about to say that yeah, so it's maybe it's really a question of the negotiation, right? So discount have been lower. That's a good one, I think. and budget too pessimistic. It's always a good one to say that as well. Okay, maybe in the budget, 120 was not the right price to take into account in the budget. Okay, and so in that case, we come back to what we were saying here in the PDF document. Okay, which is the fact that we have some feedback to provide also to the budget department. Okay, so you guys took into account 120 in the budget. Maybe next budget you should take 125. Okay, so that makes the performance harder for the selling team, right, for the next period, because the target to reach is higher. But you know, we have to be careful. If we stay 120 where it's usually 125, it means also what we do budgetary slack, right, as we were saying. So we make the targets too easy to reach. Okay, so we can see that maybe we can imagine that the manager from the selling department have been putting some pressure on the budget department to keep it 120. Okay, because maybe some variable wages, commissions for employees are based on you know, on this difference. So you can have this game of power within firms between the managers and the budgeting team, right? Because manager will always try to have the most reachable budget to reach, and the budget team would like to maximize the profit of the firm, right? So it's not always going in the same direction. Okay, so this is what we could say about this. Just to be clear, for selling price variance, okay. Sorry, it's going to sound strange a little bit what I'm going to say. It's only a price variance. It cannot be a quantity variance, okay, because both actual and flexible budget are based on 10,000 units. Okay, just saying that because we see that when we talk about direct material and direct labor, it's going to be a little bit different. Okay, so this is for this one, for the first one. Okay, this one. So we finished with this one. Let me check in the PDF document if I have something else to say that I wrote down. So let's summarize what we say here. Sales volume variance, so it's flexible budget. No, sorry, it's not this. We discussed that, 60,000, 64. Okay, so flexible budget variance for revenues is called selling price variance because it arises solely from the difference between actual selling price and budgeted selling price. Okay, so what I just said, it cannot be a quantity variance. So the way we calculate it is actual selling price minus budgeted selling price times the quantity, the actual number of units sold. So here what I did is actually, you know, so what they do here in the solution is they say they take 1,250,000, okay, divided by 10,000 jackets. So they find 125. And so minus 120 times 10,000 jackets. So we find a favorable variance of $50,000. So it's another way to put it. Okay. And so we identified some potential causes for this. And we can see also that the department of the company that we would interact here is, of course, the selling department, right? Okay, so now let's talk about direct cost inputs. So here we're gonna discuss the next two important variances, sorry, to these two ones, direct material and direct labor. Okay, these two ones are the most important ones to discuss. Okay, so this is the one we're going to focus on. So the 21,600 and the the 38,000. When we talk about 21,600 unfavorable, okay, so it's unfavorable because the cost of the direct material has been higher than the flexible budget. So what could be the causes of this one? Why we have such a negative variance? Can you in the chat give some potential explanation why we should have more cost for the direct material than expected? So the material spent more than the budget or material price is increased. Price of materials were increased. So already with Mr. Here, we have the two main phenomena which are actually identified. So it can be for direct material, it can be a quantity variance, okay, or a price variance. Sorry, I make some mistakes because I write too fast. I hope you forgive me. So quantity or price, okay? So that would be for the quantity, a number of kilograms per unit, okay? And so it could be, if it's unfavorable, it could be meaning that we used more quantity of raw material that what was planned. And for the price, well, price, that could be that we paid a higher price than expected when we bought the raw materials. Okay, so globally, if we have something something here. Okay, so globally, what is important so far is to realize that we have, let's change the color, two type of variances. Okay, so for the direct material variance, we have two type of variances, can be a quantity variance and a price variance. Both can be favorable or unfavorable, okay? So now that would be interesting to be able to calculate, okay, the 21,600 unfavorable. What is the part of it which is due to variance in quantity, and what is the part that is due to a variance in price? Okay. Okay. So this is now the next step of what we're going to do. So we're going to do to the level 3. Okay, we have level 1, level 2, level 3. Each time we go one level, we go in more details. Okay, we decompose, we split, okay, the variance into sub-variances. So we cut the variance into pieces to better understand and better analyze the situation. So here, globally, we've been able to say, so level 1 is, okay, we wanted to do 108 and finally we have 14,900 because, okay, we already have a difference in the number of units. Then we go level 2. And so, okay, now we have level 2. So we compare budgeted information and actual information for the same number of units, 10,000. Okay, and we go into the details. For the revenues, positive. It means selling price per unit has been higher. Okay, good performance from the selling department, or maybe our budget were too shy. Now for the direct material, we have a negative variance, 21,600. What is the cause of it? Is it because we used more raw materials than expected for 10,000 units? Or is it because we bought the raw materials at a higher price? Okay, so this is time now to get into the details of this. So this is a level 3. So let's come back to the PowerPoint document. And so let me get into the details, okay? I don't care about this. I don't care about this. Okay, let's get into the details of the calculation. So a standard input is carefully determined quantity of input. Okay, so normally in our budget, we know what is the quantity we should use raw materials for one unit. Standard price, same thing. We should be able to find information about what is the normal price for the raw materials for us. Okay, so by, let's say, take the data from previous period, benchmark with similar companies with similar processes, or use the standard which have been developed by your company. Okay, each of these method have a pros and cons, right? Actually, input data from past periods. So the advantage is that it's real information because they've been information that happened in the past. So it's not hypothetical. Okay. And globally, this is an information you can obtain easily because you have it in your company. Okay. The cons, disadvantages, is that maybe past data do not reflect any change in the future. Maybe the situation is different in the future compared to the past. And if we just if we just take the past information without correcting it, well, we also import with us in the budget inefficiency. And so, of course, it's going to be too budgetary slack, meaning that we're going to accept from the beginning that we get some wastage, for example. If we use information from similar companies, so the advantages is that we use benchmark that exist around the world or around our industry. But usually we have to be careful. Maybe it's not strictly comparable to our situation because of the size of the company or something like this. And it's often not available, right? Especially management accounting information is usually very hard to obtain, or it can be expensive to obtain. And for the standards developed by the company, of course, standards exclude past inefficiency. So it's like we take information from the past, but then we reanalyze them and we set a standard, okay? And the problem is, of course, they are not based on achieved benchmarks. So maybe we have to be careful because they can be, too hard to get or too unrealistic. Okay. So now let's get into the details of the price and quantity variance. Okay, so for the price variance, we're going to use its actual price minus budgeted price times the actual quantity of output. Okay, so let me come back to what I have in my document here. So for the price, what's going to be used first? Okay, so let's say that we go for the price first. So I put it first. So we're gonna do actual price minus standard price, okay, times the actual quantity, okay. That's for the price variance. That's the price variance, okay. This is how you should calculate it. And if we go back to the PDF document, and if we get a little bit later, so we have what we call efficiency variance. Okay, efficiency variance is a quantity variance. So it's actual quantity minus standard quantity times standard price. Okay, so we can go back to the document we have, and so it's for the quantity variance, it's actual quantity minus standard quantity times the standard price. Okay, so that's quantity variance. So usually what we do, so you have to remember these, right? And so usually what we do, if I go this way, so we have the actuals. So the actuals is QA times PA, right? Or PA times QA, okay? Then we make an intermediary, we change the price, so we go from PS times QA, so we change only the price, right? And so here, between the two, we have the price variance, okay? And then we change the other one. So we keep PS and we now change QS, okay? And when we do this, we do the quantity variance, okay? So this is how you can remember how to calculate the variance if you don't have the formula, okay? What I say usually is that you go from the price to the quantities and from the actuals to the standards. If you remember this sentence, let me say it again. You go from the price to the quantity and from the actual to the standards. You don't need to remember nothing else. It's finished. You go from the price to the quantity, actual to the standards. Okay, price first, actual first. Then you go from price to quantity. So you should change the price from actual to standard. Okay. And then you change the quantity from actual to standard. And so that you know how you can use your information. Okay, so if you know this sentence, you go from the price to the quantities and from the actuals to the standards. You don't need to know the mathematical formula. You just need to remember this sentence in your mind. Okay? Okay, so it also means that you need to identify 4 things, right? QS, QA, PS, PA. Okay, so you need to identify this. So because the formula are not so easy sometimes to remember or to calculate, this is my first advice. You should go. So I'm going to level 3 analysis, which is the next step of your calculation. Okay. And so my advice is that you should always firstly do this. Identify QS, QA, PS, PA. Okay. And once you have that, you can go here, okay, and calculate the different things. Okay, actual cost, of course, will be QA times PA, okay? Actual input times budgeted price, so PS times QA, QA, sorry. This is what I said here, okay? And so. So now it's time for you to try to focus on direct material, okay? To do so, you need some additional information. Some details about the quantity and the prices. Okay, so this is a summary of what I just said earlier, okay? That put in the Excel file. So additional information. Okay, so you need, of course, this information to be able to calculate the quantity and the price variances for direct materials. So standard direct material cost per jacket, 2 square yards of clothes inputted a load for output unit at $30 standard price. Okay, so you need this information and you need this information as well. Actual direct material cost. So you can calculate. So these 2 paragraphs are gonna help you now to get into the Excel file for the level 3 to imagine what is QS, QA, PS, PA. So the other 2 paragraphs are for the direct labor. So we talk about that later. Okay, so you use these 2 paragraphs to be able to go into the calculation of this, okay? This. And once you have that, you can do this line, right? So you can calculate the price variance. You can calculate the efficiency variance, which is a same thing than the quantity variance. And so then you're going to calculate the price variance, efficiency variance, so you can calculate the total variance, which is price plus efficiency. And of course, that should be the same thing that you find here, 21,600. Okay? Any question? If you don't have any question, I'll let you 5 minutes to calculate quantity and price variances for the raw materials. And then we discuss the solution. 9h16, so 21. So that's the very good question, Dong. Why is QS for 10,000 jackets instead of 12,000 jackets? Because we want to analyze the difference between the flexible budget and the actuals, not the difference between the static budget and the actuals. Okay, so even when we take the standard quantity, we take the standard quantity, that quantity that we would need to manufacture 10,000 jackets, the actual output. Okay, this is what we want. Okay, so again, we are analyzing the difference between, we are analyzing this one, right? 21,600. You can see that this 21,600 is between two information built on 10,000. As we were explaining earlier, we do not want to compare a budgeted information for 12,000 and a real information for 10,000 because it's not important for us. Okay, so when we do the level 3 analysis, we already here, right? We already stop. We don't care about this one anymore. It does not exist anymore. Okay, we are here now. We're focusing on this. And in this information, both sides have 10,000 units. Okay, so even if we are talking about the standard quantity, this is a standard quantity to be able to manufacture 10,000 jackets. So what is the standard number of square yards that we would need if we manufacture 10,000 jackets? So we can compare to the actual quantity we use. Yes. Thank you for your question, because this is really the main point. So I hope everyone understood, because this is really the most important thing to understand here, that even if we are talking about the standard quantity, we are talking about the standard quantity for the actual output, 10,000. Okay, so 2 more minutes and I give the solution. Okay, price variance. So we have a first price variance from Chang. You tell me, but I don't remember, so I need to check on the official solution. Yes, that's correct. Price variance is 44. That's correct, Trang. Okay, so I give you, maybe do you need some more minutes? You want three more minutes? Or is it okay, I can correct? Because I have only one person who answered in the chat, so it gives me the sign that maybe you need more time, but I want to be sure. And efficiency variance 66. That is correct. That is correct. Okay, 2 more minutes. So we got one good answer. Congratulations, Chang. Are you finished? Do you need more time? Okay. Okay, so let's correct. So okay, so I'll try to organize my screens so I can see everything at the same time. Okay, so you should be seeing my screens. Okay, so it says that we need 2 square yards. I'm just reading the PowerPoint. Huh? So if you wonder why I find this information, 2 square yards per jacket, okay, per output, okay, and so time 10,000 units. So here my standard quantity 10,000. Okay, so each time I manufacture one jacket, I should use 2 square yards of cloth, okay? And since I do, since I manufacture 10,000 units finally, so for 10,000 units, I should use 20,000 square yards of cloth, okay? In reality, we use 22,200. So nothing to calculate here. It's an information which is provided in the case. Then, coming back to the first paragraph of the slide, $30 standard price. Okay, $30 standard price. And now, actual price, well, this one we don't have it, so that's why I said you need to calculate it. So I go back to the level 2, and I know that I used this amount, so I'm going to take it in absolute value, divided by the actual quantity. Okay, so I reconstruct the actual price from that. So this is 28. Okay, so again, it's 621,600. So the total actual cost, okay, divided by the actual quantity that I know. So I reconstruct the selling price. Okay, so now I go here. So what is actual cost? It's QA PA. Okay. What is the actual input quantity time budgeted price? So QA time PS. Okay, so this is QA time PA, and this is, sorry, I'm going to put it the other way around. PA time QA, okay, and this one is PS time QA, okay. And the last one, flexible budget, is of course PS time QS. So it's this one time this one, okay? So now I have my 3 information. So if I want to check, this one should be the same than this one, okay. And for the flexible budget, 600, it should be the same thing that I have in my 600, okay. So I'm well taking these two, you know, these two I don't know how to put it, these two information, okay. So it's correct. So what I just do is I, again, like for when I go from level 1 to level 2, I just put an intermediary step. This is also what I do when I do level 3. I put an additional intermediary step so I can split the total variance between a price variance and an efficiency variance. So actual minus, okay, so here I forgot, okay, I'm not gonna put it in yeah, I'm not gonna put it in the absolute value because I want to keep to keep cost into negative value, so I can, so the variance that I'm going to calculate will be the good sign already. So it means that when it's positive, it's a favorable variance. But anyway, I'm going to check what I have. If you didn't put negative sign, we can still imagine, because here again, as I said, be careful about the signs. Okay. So what you need here to know about the selling price, the price variance, is to say, okay, my actual cost is 621. The budgeted cost is 666. Okay. So it means that actual cost has been lower than the predicted cost. So it's a favorable variance. On the other hand, for the efficiency variance, so I should have, so it has been 666. I should have had 600. So it's negative 66. So it means that we have an unfavorable efficiency or quantity variance. Okay. Quantity variance. Okay. Total variance is the addition of the two, selling plus quantity. Okay, that's 21,600. And so I check in my level 2. It's 21,600. So it's okay. Same. Because what you have to understand, of course, is that total variance is nothing else than price variance plus quantity variance. Okay. So adding back these two variances are calculated here and here. I'm just checking that I have the same thing that in the level 2. Okay. If it's the same, maybe it means that my calculations are correct. Okay. So we have a favorable price variance. Okay. So our price variance is favorable. It's favorable. Okay. Because we paid 28 instead of $30 for 1 square yard. Okay. This is what we see here. Okay. So here we could say, okay, so which department in the chat, can you try to tell me which department is more responsible for this good performance, in your opinion? We bought the raw materials at a lower price than what was expected. Well, I guess maybe a good performance from the purchase department, right? Okay, because we paid at a lower price than what expected. And each time we can imagine two types of reasons. Two types of reasons. Internal reasons or external reasons. Okay, so internal reasons. So, as we say, maybe a good performance from the purchase department. So good negotiation, okay? Good negotiation from the purchase department. What do you see as a internal or external explanation? What could be an external explanation for this? What could be other good reasons why we have a positive, favorable variance market? Okay, so yes, so the price of the raw material has been lower than expected on the market. Okay. Okay. Discount from suppliers. So good negotiation. Discount from suppliers. Something else? I have one when it comes in mind. We changed the raw material we bought. Okay, different quality. So we changed the material we bought, so different supplier. Okay, so maybe no, different quality. Maybe we change the supplier. Okay. Discount from them, we change the price. Yeah, I agree with you, Hang. Okay. The price of the raw material has been lower than expected on the market. Okay, so what I say here is that you can always do internal and external explanation. Okay, you can always do this. And you can always, yeah, you can always do this. And so usually when we talk about internals, we can influence this. Okay, external, we cannot influence this. Okay. Okay, so when you have a positive price variance, okay, so normally you should identify the purchase department, okay, and then so this is the responsibility, right? Who is responsible for this? And so we can decide we can influence on this, which is internal. Okay, so maybe the purchase department made a good negotiation of the price they pay for the raw materials, or maybe for some reasons we obtain discount from suppliers. So maybe it's a good negotiation from our part, or maybe, I don't know, for some reasons, maybe it could be that we bought a bigger amount of raw materials at the same time. Okay, so we have more discounts, but maybe that means that the raw materials will remain a longer time in our factory. So it means that we need space to find space, or maybe some of the raw material can lose value. Okay, so that, you know, that kind of question we can ask. So here, to this level, when we do theoretical cases like this one, we of course we cannot find answers. We can only raise questions. But this is your job to show that you are able to raise the good questions. Okay. If maybe we change the raw material we bought, right? Maybe our purchase department negotiated with someone else, and so we changed also the quality of the raw material. So we have a lower price, but maybe we have a different quality. Okay, and this thing can be linked to what happened in the quantity we use. If we change the raw material we buy, okay, the price is maybe better, but maybe we will have more wastage, right? So that will influence the negative performance in terms of quantity, okay? But all those things are things we are responsible for. Internal reasons are things we can have an influence on. When it's external, we cannot usually influence it. If the price, as some of you said, has said market, yes, so if the price on the market for the raw material has been lower than expected, okay, so it means that, okay, we benefit from a situation. But then we should maybe consider that the feedback should be given to the budget department. Maybe they should change for the next budget period, 13 into 28, or not. I don't know. Maybe it's we need to wait a little bit more time for this. Okay, so that's for the price variance explanation. Sorry. So about the quantity variance, which is unfavorable, okay. Quantity variance, which is unfavorable. Okay, so same thing, huh? We can find some internal reasons and some external reasons. And we can also think about which department, okay? So do you have any potential explanation for the quantity variance, which is unfavorable by 66,000? So we used 22 instead of 20. So we used 22,200 instead of 20 square yard. So theoretically, is a bad performance from the production department. Okay, these are the guys who are responsible for this. Okay, so do you have any reason? Do you have any explanation for this? Why did we use more square yard than expected? I would say we used a less qualitative raw material. And so we have more wastage. Okay. What could it be? Less productive machines, yes. Less productive machines. Okay, less productive machines. That can be linked to bad settings, right? Bad setups, bad setups. Maybe it could be also employees badly used the machines. Okay, maybe new employees that just arrived. Okay, that could be another explanation. More complicated design pattern, yes. So specific orders with more complicated designs or patterns. That's excellent. Tested products, okay. Tested products meaning we took some more time to test more products. So we did some that would go with the settings. Samples, exactly. So that could be good explanation. Specific orders with samples. Sorry, tested products. I didn't put it. That is tested products. All those things, would be good explanation to defend the department, right? The production department, because we have maybe a bad performance this month, but maybe for specific reason that will not happen again. Promotions, so I think it goes with samples. So promotions in the sense that we offer samples, I guess. If it's about the price, it's not there, huh? Because here we are talking about the quantity variance. Okay, so about what we cannot influence, the supplier provided us with poor quality raw materials. Okay, we did not change the raw materials we buy, but we've been given some defective quantities. That can happen. Okay, that could be an influence. That could be something we done. Okay, so I think you get the point, right? So quantity variance, firstly, it's more the question of the production department. Okay, certainly. The other one is more the purchase department. So by splitting, it's a little bit theoretical what I say here. It's a little bit simple, right? But at least to give you the idea about what we can do with variances and subvariances. So here we can better by splitting the variance about raw materials between price and quantity. We can maybe more identify what could be the good and bad performance, and maybe who's going to be the person we should talk to, right? Is it more a question of purchase department, purchase manager, or production manager? Okay. And always you can split into internal and external. Okay, so keep that in mind. Which department? Is it internal, external? And then we cannot at our level find reasons, but we can raise questions. Okay. So we have 10 minutes left. I would like that we able to do the direct labor variances, at least for the calculation. So if we have a look at this, we can, so hopefully you can see my PowerPoint document. And so we have information about the labor. So standard direct manufacturing labor cost per jacket, so 0.8 hour, okay, standard price 20. And actual, we have been using 9,000 hours, okay? So I let you 5 minutes to calculate the the variances, so QS, QA, PS, PA. Okay, so I'm coming back to my Excel file. Okay, here. Okay, so you do this. No, I'm gonna make it different. You do this and this. Okay. So I let you 5 minutes and then I correct. Okay. So we finish with this one today. So I've got some answers from Hong. Let me check. This is correct. This is correct. Bravo. Yes, both are unfavorable. So Mr. here brings something else in the discussion, which is to qualify the variances. Okay, unfavorable, unfavorable. Both are unfavorable. So we have both a price and quantity and unfavorable, which is interesting. Sometimes one is positive, one is negative, and here both are negative. So it seems that maybe there is something to think about. Okay, I'm gonna correct now. So we have the information. So let me okay. So we should have used 0.8 hours for 10,000 units. $8,000, right? And QA was finally 9,000. PS, it's $20 per hour. And PA, well, same thing than for the other one. We have to recalculate it using this information. So total amount have been 198 divided by the actual number of hours. So let's put it in absolute value here. It's cleaner, 22, okay? So for the direct labor actual cost, so QA times PA. For the intermediary, we got PS times QA, and that should be minus. And for the flexible budget is QS times PS, okay? And so now we can calculate the variances. Okay, and so that's unfavorable. That's unfavorable because we have more actual cost than what expected, and we have more intermediary costs than the flexible budget. Okay, variances are on the whole. Sorry, I'm not taking the right information. So I've got a problem with my efficiency variance. Okay, better. And so that got 38. And let's check that this is what I have. Also 38. Okay, so that's correct. Okay. So this is what we can do here. So I would like to tell you something that I forgot to tell, which is the fact that in my approach of the variances, because I know And I remember when I was a student, a long time ago, it was also complicated variances because people get lost easily. So I try to give you a method that I know the way I understand things, okay? And as you can see, when we calculate the direct labor variances, it's the same thing, right? It's the same approach than for the direct material. It's a quantity variance and a price variance. It's just that the quantity we are talking about is not the same, and the price we are talking about is not the same. For the direct material, the quantity is in here. It's a number of meter square or square yard, okay? And the price is the price per square yard for the raw material. Of course, for direct labor, what we are talking about for the quantity is the number of hours people spent to manufacture 10,000 units. And the price is the cost per hour, right? But it remains for both situations a cost, let's say a price variance and a quantity variance. And the formula are the same, okay? It's just a quantity issue and a price issue. It's just that now we have to step back and imagine what could be the reasons why we have a good or a bad performance for the direct labor when it comes to quantity and price. So for the price, it seems that we plan to have a $20 cost for 1 hour of work, and we have 22. Okay, so it's been more expensive for us, for the human resources. And for the quantity, same thing. We used more hours than what we planned to do. Okay, so why is that? Okay, who is responsible for this? Okay, so we have only 2 minutes left, so it's not we don't have the time enough to make the interpretation. So I would like you for tomorrow to try to mark down a few potential explanation using the same way, you know, internal, external, and for the price and for the quantity, but for the human resources. Okay, then okay, so that's going to take a few minutes. Then we finish with the other variances. So maybe we need maybe 45 minutes, hopefully, to finish everything tomorrow. Then I guess we need one hour. So I present you the balance scorecard, so the last chapter. And so we would have maybe 45 to 1 hour left. So you work the first time in groups. What could be also helpful, I know we didn't study the topic yet, but you know your groups, right? So maybe you can anticipate and discuss together what you can do. Let me share. I don't know if you have that already, but I think you have it for the group work. I hope it's something that was shared on Canvas. So this is a document, okay? You can see that I use the same, okay. So that will be about creating the balance scorecard. So balance scorecard, we talk about it tomorrow, okay? For a new project that you intend to develop using data that you will estimate or theoretical structure of the balance scorecard presented in class, okay? You can choose an activity of any activity of any project. Please notice that choosing an activity project you know or for which it's easy to gather or imagine information is highly recommended. The new activity project can, for example, launching of a new brand of product of an existing company, the opening of a new shop for an existing brand, or the opening of a new subsidiary in a new location for an existing group. So the job you will have to do in the balance scorecard is to imagine the balance scorecard, so we will discuss that tomorrow, but for a new activity that you launch, okay? So maybe if you have the time together to discuss this. If not, we will have still 1 hour to discuss that after I present the theory about the balance scorecard tomorrow, okay? So, so please read this document at least. Imagine what could be, so it has to be launching of a new brand, opening of a new shop or new subsidiary in a new location. So it's like you create something, okay? So the balance scorecard will be you are the manager of this new brand or this new location or this new subsidiary or this new this new shop, okay? And imagine what could be the indicators you develop. Knowing that the indicators, of course, we discuss that tomorrow. So maybe it's a little bit shady for you now for the moment, just in case you have the time to discuss with your group already. If not, again, we should have maybe 1 hour left at the end of the session tomorrow to discuss this. But we have 8 groups, I guess. So I will have only 5 minutes for each group, sort of, to go into the groups. So what we will need to do tomorrow, you will, as a group, have to decide what is your project you want to do, okay? And for me, I will just check with you that what you intend to do is something which is feasible, okay? I'm not sure it was a good idea for me to present that now because we didn't discuss what is a balanced scorecard already. But just in case you want to think about it already, we can see it. Okay, but if it's not clear for the moment, do not worry. Huh? We have a few time tomorrow to discuss this again. Okay, so it will become clear tomorrow if it's not clear for the moment. Okay, so our timing for tomorrow, 45 minutes to finish the variances, then 1 hour for the theoretical presentation of the balanced scorecard. Okay, and so that's 1:45. So it means that with the break, we have 1 hour left to work in groups. It's enough. It's enough because we just have to decide what is the project you would like to work on, and I will check with you. Okay. So sorry to launch that. I'm not sure it was a good idea. I wanted to say, oh, maybe I should discuss that now. You noted a lot on your Excel file today. So could you please send us the file? You can delete all the formula if necessary. Okay, I will try to do that. Okay, I will try to do that. At least, yeah, I will try to, yeah, okay. Think about it. If I forget, please tell me, huh? Because I've got another meeting now, so maybe I will. But yes, I will try to keep all the notes I took in the file already. And what I'm going to do is I'm going to put all the notes in the file I call the Blackboard. Okay, the Blackboard for today. So I'm going to copy paste all the notes I took. Okay, and so I will call it level 1, level 2, level 3. And so you can, I think you can link with what you have. I think this is the best solution. Okay, is that okay for you, Trang? Okay, I think it's a good compromise. Okay, a little late here, 10:04. So enjoy your evening. Don't worry about the balanced scorecard. I hope I didn't scare you. Don't worry, we'll find solutions. Huh? We always do, right? So just if it's clear for you, think about it. If it's not clear, you forget, and we discuss that tomorrow. Okay. So please enjoy your evening. We finish that tomorrow, and see you at 7 p.m. tomorrow. Okay. Okay. Thank you, Ha, and see you tomorrow, everyone. Enjoy your night and the rest of the evening. Thank you very much. Bye-bye. Thank you, everyone. Thank you, Leon. You tell me what Tam Biat Tai means. Have a nice day. Good afternoon. I will check. I'm going to Google that. Okay, bye-bye, everyone.